Dave Putz here from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Hello,
All right. How are you guys doing?
hello. Good. We're on the road. We're
Oh my,
currently
where are
in
you
Utah.
at?
We're on our way home. We're right now in Centerville, Utah, and then heading up. My daughter got accepted to a college up in Idaho, so we're going to go see that place. She's never actually been there. She's been accepted, but she's never actually been there, so we got to go check that out on the way home.
Nice. Nice. Awesome. So I know Nathan's on
Yeah,
a camera thing, so our videos will be a little wacky. I'll fix it as we talk here. But today we're gonna be talking about bridge loans and hard money notes. And it's something, Nathan, have you ever got into that kind of space?
I'm really curious about it. I've looked at it from a few different people that are doing this. It looks like it's a really interesting investment opportunity. It's something I want to learn more about. So I'm glad that we've got a guest on here today.
And I know that it's big space right now, right? I know that we're curious about because it's a much different angle in all this play. So for those who are curious
Mhm.
about it, we will have this replay. This will be on our YouTube channel as well as our podcast. So you won't miss a thing. It is being recorded. So um, what's been new with you besides taking your kid to all his college stuff? What else you been up to, my man?
I took the last couple of weeks. I'm supposed to be raising money from my fund, and I was like, you know what? I've got too much going on. Capital raising's going to the side for a minute. We're figuring out DME. So while I've been away, while we've been kind of away on this semi-vacation, just about all the sponsorships are sold out. So if there's anybody who wants the sponsorship, speak up now. And speakers are all set. Just got a couple of speakers that I got to lock in, but DME is coming along together really well. We've got just under 2 months till
Yeah,
showtime, so we're getting very excited for that. Looking forward to seeing
it's
everybody
quick.
there, and
And for
yeah,
those who
it's
don't know what
good.
DME is, Diversified Mortgage Expo, it'd be happening in Nashville at the end of May. It
Mhm.
will be a combination of note buyers, note originators, and experts around the way, service providers, everything else. So it's definitely a different kind of market than you've been to. Most we
Yeah,
found seller finance people don't have um, a a conference to go to. So it's definitely a whole lot different than what you think it is, right? Getting together with people that you
yeah,
are experts in the room, really knowledgeable people all in the same room with stage and all that stuff. Looks all pretty and fancy and all that stuff. And you get together and network. That's our biggest key here is networking and getting deals done, buying and selling, trading and learning about it.
you have to get to know people in the space. Like it's so. And we say this all the time, but it can't be more true in this space, especially. It's all about relationships. So it's all about getting face to face with those people that you're going to be doing business with, because that's how you grow those relationships, and then that's how you get deals done, that's how you get business done. So
Yeah.
I highly encourage everybody to come out, get to know people in the space, meet, like you say, service providers, vendors, like, and I it's not just anybody that can come. I'll give you an example. So last week I had someone reach out that wanted to be a sponsor at the conference. And I said, okay, sure. Can you tell me a little about your company? I haven't you guys before. Medical devices. And I'm like,
Yeah.
what? That has nothing to do with anything. So the answer is no. No, we're not. It's not just free for all. Anybody who can come. The people that are coming there are people that are in the business that I've worked with personally, that you've worked with, Dave, and people that we
Yep.
know are real assets to your business. So it makes a big difference just to be there in person and getting to know people.
Awesome. Yeah, I did see we had a little audio trouble. I did fix that. I don't know why it did what it did, but it is what it is. So I think for me, DME was allowed me to connect with people that are not in the note space, right? Or not in the note buying space. And picking brains of people like we're having guests on today, saying, I don't understand why you do this or that, and kind of get a better understanding from their point of view so that I can be a better buyer of these notes and say, how can I put myself in a win-win scenario that allows you to
Mm-hmm.
grow your business, me grow my business, and we all win, right?
Yeah.
Um, we have certain things we got to hit individually, but that's where it comes back to. So it's cool.
Yeah.
Well, let's jump right into it, and we'll
Yeah.
bring in our guest. Uh, I'm going to call him Matthew. We haven't correct anything else. Is Matthew good or Matt better, or you tell us?
Either one. My friends call me bad words, so it's not really, you know. Matthew
I
is
hear
totally
that.
fine.
Awesome. So, Matthew, tell us a little bit about your background. How'd you get into real estate to begin with, and how'd you get into the niche you're actually in today?
Yeah, no problem at all. I appreciate the invite and looking forward to sharing some of the knowledge and the new income strategies that come with investing in different types of notes and things like that. And so I'm a CPA, so the math stuff to me is really an unfair advantage, especially in the note space when you understand arbitrages and things like that. It's really interesting.
Mhm.
I didn't know any of that in the beginning, right? I worked at a CPA firm doing tax and audit, got to work on some larger real estate clients and things like that, and didn't know what I wanted to do. Was just bored out of my mind, wanted to bang my head against the computer, going, I can't do taxes anymore. I can't help the government steal people's money anymore, you know. So and I just had to like do something else, but I didn't know what to do. I'm like, should I start a bar? Should I like what the heck should I do here? And actually, my stepbrother came to me with some education on real estate, and I ended up being extremely passionate about that. And I got my first deal under contract that I was going to flip, and this was in 2006. And so I went and got the deal under contract, quit my CPA firm job. I had about 30 grand in savings and just said, forget it. I'm going to be a full-time flipper now with like a year of real estate education and no real experience at all doing
Oh
it.
my
And
God.
so, yeah, I was like, I'm just thinking in my head, I didn't have kids at the time. I could go back to the CPA firm or another firm or whatever, you know, but something different that didn't want to make me cry every day of boredom. You know what I mean? So, and so I ended up quitting. We started getting a lot of properties under contract. Actually, my two stepbrothers, both computer programmers and electrical engineers, both quit too. We got an office at the World Trade Center in Long Beach on like the 23rd floor in 2006, thinking we knew what the hell we were doing and thinking we were dope because we were flipping a bunch of houses all of a sudden and getting a bunch of properties under contract. And then, of course, 2007 happened and 8 happened, and we realized we were not dope and we had no idea what the hell we were doing. And, you know, I thought we were good business owners because my books were done and I'm a CPA, right? Still a technician in my mind at that point, right? So,
Mhm.
and I ended up taking 200 grand out of my credit cards. I paid my investors back with that because my investors I had a 790 credit score. And, you know, back then you could get lines of credit like crazy. And I'm like, raise it again, raise it again. I'm going to
Mhm.
use this to buy real
Wow.
estate. And so I went and we had a bunch of private investor capital involved, and we took like 50% hits on our acquisitions during that time because we bought like 36 houses with all our investor capital and some of our capital, and we are going to lose like a couple 100,000 of investor money. So we just basically we took it out on our credit cards and paid it to them, and went down with the ship and pretty much lost everything. It was probably the most humbling experience of my life, you know.
I can
So of
imagine.
course, and my ego was destroyed at that point, which was probably the best thing that ever happened to me, honestly, because now I'm like, where's that left hook going to come from? You know, even if I have a lot of experience now doing this, you know, back then, that punch in the face was like, you realize how strong you can be by standing back up after something like that, you know, and you need that because you're going to get punched again, you know. So
Yeah.
uh, and so since then, we flipped a little bit over 1,000 houses now. We have about
That's
35
wow.
million lent out to flippers in different markets around the country. I've raised a little bit over $150 million for real estate. The CPA license helps with that, of course, you know, with the
Yeah.
raising the capital thing. And, you know, we invest in all different types of syndications from mobile home parks to multifamily to debt structures, other private businesses, and a lot of different debt structures, not just hard money and things like that, but I really love the debt aspect of things
Yeah.
quite a bit, and there's benefits to that and benefits to real estate directly, of course, within the tax code and long-term wealth building and things like that. So that's kind of my story. I live in Southern California. I call it communism for the people out of state in different areas,
Mhm.
and but I don't pay taxes really because I'm a CPA and understand the strategies. And so but at the end of the day, you know, I have a couple of kids and I really just love the note business because it can be a lot more passive than, you know, actively flipping and actively being involved in real estate. And I want to spend time with my kids, you know, my 8-year-old
Yeah.
and my 4-year-old. So it's
Oh,
pretty awesome. So,
yeah, that's
but yeah.
awesome. So when you first got started, how scared were you?
I think I was naive at the time. I thought, hey, I'm gonna have time to go to the gym now every day, and I'm gonna have all this extra. I don't have to drive to work. That saves 30 minutes. You're like, what is 30 minutes if you're an entrepreneur and a business owner? Like you're like, oh, okay, yeah, work 14-hour days now instead of 10, or at a CPA firm, right? Or 8, and
Yeah.
actually care now instead of before. Like you're emotionally connected much
Yeah.
more, right? And so yeah, and realizing the ebbs and the flows of the emotional aspect of things was key. But I think I was scared and nervous, but I felt like I had something to fall back on. If I don't know that I would have done it all over again if I knew how hard it is, as far as just jumping ship without having like a set income stream. So everybody has their own differences. I didn't have that much to risk at that time because I didn't have, kids or anything to take care of. If I had kids now, it's a different story. You have to eat, so, but yeah.
Yeah.
Good
Absolutely.
stuff.
That's amazing because I think people, they think entrepreneurs, they think freedom and opportunity and lifestyle, and you're like,
You're like, no,
yeah, no,
I don't think so. Not yet. So you're
There's
building
work
towards
involved.
that.
yeah,
Yeah, there's work involved, and yeah, that's a good point because people coming into the business are like, oh, so notes is like it sounds really easy. Sounds that way, doesn't it? Yeah.
yeah,
It's funny being a hard money lender. I feel
Yeah.
like I'm a property management company and a flip company because I have to manage the renovations still, and then I have to deal with collections when people just ghost you for no reason. Like we've had people close on a property, literally put money down on the property, and then never speak to us again. And we're like, what is going on? Like, and we just, okay, thanks for the 65% loan to value house, So like and so it's just interesting. It's crazy, this business. There's still very much activity or activity that needs to be handled by your team if you want to be passive. It's like any business. If you don't build your team from the start, you're going to be, self-employed. And I had to learn that the hard way myself, just like most entrepreneurs.
yeah, absolutely. So it's amazing that, we talk about this stuff. And for me, we chase a lot of different things, but what is your typical term of your notes that you're creating now? Are they 6 month, a year? Where are you at in your creation of the notes you're creating?
So I do a number of different notes. So a lot of it depends on the strategy that I'm deploying. Many times I buy, renovate, and turnkey properties, and then renovate and tenant them, and then resell them to another investor that wants the cash flow. And I'll sell them to people's IRAs and 401ks. Usually maybe 7, 8%. It depends on what the cap rate is of the property, of course. But I'll fully amortize it over 15 years and sell it to their IRA or their 401k, or I'll structure 1031 exchanges for people based on that rental property and structure the debt piece, the equity down payment, and hit the right metrics for people's 1031s. That's one of the big strategies I started with. It got me into the hard money lending space on construction debt, and what taught me the ropes on being able to say, okay, how do I mitigate the risk on this construction debt? And knowing the renovations and the flip side of things, and then coming right back into the construction side and the lending piece of it was kind of a perfect play because I knew where the risks were. Not that I didn't make mistakes and get punched in the face and had make realize that, wow, not everybody is a CPA that understands money management, and cash bucket systems for your properties and things like that, right? So but at the end of the day, my typical structure now, if I'm lending to the general public, usually, or people flippers in different markets around the country, I usually stick first with certain markets that I like to invest in that are non-judicial foreclosure states, so that I don't have to go through that process. That's bit me in the past, of course, where it takes 7 months or 8 months to foreclose on a property because some issue there. You also want to make sure you know the neighborhoods really well and the borrowers, because if you market the wrong wrong terms to your borrowers, you're going to have the wrong borrower. So we went through in the beginning, right now we're doing 65, 70% loan to value loans, maybe at around 12% interest rates, 2 flippers with them putting, 90% of cost usually of purchase and renovation, and they got to pay for the entire interest up front on the loan. And we hold that in reserves, and we hold back the entire renovation in reserves. So usually it's like 6 months of interest hold and then the full renovation hold, so that way we can apply those payments. So they're not having to make payments during that process, and they know where their cash is, so their money's in up front on that piece of it. And it's usually usually 70% max loan to value on the after repaired market value, and then construction draws as they finish the renovation with inspections each time they do a draw, so that way we're really safe. We're usually doing 1 year loans, but sometimes we'll get extensions, especially when the interest rates change and things like that. People are waiting to see are rates going to drop so I can refinance on a debt service coverage ratio loan for my rental in that scenario. And one cool thing that actually happens out of this is, one, I get a ton of deal flow just by lending to the direct public like this. And I'm like, oh, you don't have the money to do this. I could take it down, and actually partner with some of them. It's bit me in the past on certain partnerships, and doing the homework on those partnerships are key, of course. But being able to come in and say, hey, you're having a hard time selling this property off, maybe you can do seller financing to a homeowner, and then we'll leave my loan in place, or I'll help you out on a long-term rate instead of a 12% short-term rate or something along those lines, and make my interest rate spreads between myself and my investors, and they can go through and make their spread on their equity piece of the deal too. So it kind of plays to each other, but that's my typical terms: 12 months, 12% interest, maybe a couple of points each time or something like that, unless I have a very big borrower, in which case we usually drop points or make it a very, easy type of fee for really big borrowers that are working with us for a long time, so.
That's a lot.
Interesting. So one of my concerns, with the short term, how do you ensure? I don't know. To me, it just seems like there's a bit of a risk in there, in that maybe they got in over their heads, or maybe they've got in where they, I just don't know how you do the due diligence on that to make sure that it's a good loan 12 months from now.
Yeah, absolutely. And that's the hardest part, right? Is the due diligence and knowing what to look for when you're analyzing these types of deals to see if it's a good fit. The first thing, just like anybody you're doing business with, is who the heck am I dealing with in the first place, and what is their experience in doing these deals? Can they show me their last 5 HUD closing statements on their purchase and their sale, and show me that they actually did that? Can I see before and after pictures? Do they seem buttoned up? Are they communicating correctly on their correspondence with me, like quickly, and being able to, provide proper documentation? What does their rehab bid look like in the first place? Is it just, BS numbers where it's not detailed out, or is that on like a chart that they use every time, cookie cutter, with every line item outlined in depth, where they're even on an initial estimate, right? So you're gauging who that person is from that regard. And then the other big risks, the biggest risks here are, their experience, what I just talked about, but also, do they have cash? They're in their cash reserves. And is those cash reserves going to other projects that they have in process, or are they staying on, are they available for your project only? Do they say, hey, they got a couple of more flips going right now? Okay, great. Then, like, do you have the money for those? What's left on the rehabs of those? Are they done? Can I see pictures of those, where they're at right now, and the full budget and what you spent on that, to make sure that, you're not going to commingle, because that's how flippers get in trouble a lot, is, running out of money, and then on the other side, the other biggest giant risk, obviously the appraisal, and the appraisers are not always right. And if you're investing in a market that you don't fully know yet, then you need to make sure you get another check and balance. So we do our initial internal underwriting of that value. We go get an appraisal done also, and then we also get the opinion of another outside agent to be able to tell us, what does that street look like? Because the appraiser may be looking at something a block away when that street sucks, you know? So
Mhm.
it's like we've been bit by that. These are all things we've lost money on in the past and learned. And then the final
Do
thing is
you?
the renovation bid in the first place, right? Because
Yeah.
some people sit there and they'll tell you, oh, I can get it done for 30 grand. I'm like, no, well, I
Mhm.
can't. I can get it done for 60. And so I don't care if
Mhm.
you're doing the labor yourself or their contractors underbid the job. So you can get what's called a feasibility report and get because you're not dealing with homeowners in a lot of time where it's more difficult to get into the property, do an inspection. You're able to get full access to this thing, get into the basement, like have them take the bid and have the feasibility company come out and literally look at it line item by line item and say, is everything here? And does that seem right?